So, welcome to the webinar series 43, which is into regulatory requirement and overview of internal control frameworks. So, today we have a very good speaker with us, CA Mohit Gupta. So, Mohit sir, we welcome you
Thank
on
you.
this session, and I'm sure the session will be very nice session. And I request all the participants to be attentive, to post their questions on the chat in middle, between, and make this session very interactive. So now let me introduce Mohit sir. So CA Mohit Gupta is a experienced risk professional with more than 2 decades of experience to lead large and complex engagement of internal risk management, automation, internal control framework, investigation, and developing standard operating procedure. So I told Mohit sir, I am very impressed that you are a chartered accountant as well as a software engineer. Yeah. So he's engaged with SNB as an executive director, and he has worked with several renowned organizations such as Mazar, Deloitte, Genpact, KPMG, where he has supported his client for delivering various risk consulting engagement covering the wide range of sector across the globe with the main focus on manufacturing, energy, and automobile sector. So, sir is a member of Board of Governors in the Institute of Internal Audit. So, he had co-authored various books. So, Mohit sir is engaged with ICS, Company Secretary Institute, ICAI, and IIA as a faculty and speaker on internal audit, data analytics and internal controls, and new way of doing audit leveraging technology. So we welcome Mohit sir again,
Thank you so much.
and
Thank you.
so let us start the session.
Sure. So look forward for that. And I welcome all the fellow colleagues and the participants and the attendees. It's going to be very insightful session because the topic which we are taking today, it's important for all people, like be the statutory auditor, the internal auditor, be the management, because the risk and the controls is the subject which directly or indirectly impacts all of us in our daily professional work. And I'll try to link it to our daily way of operating also, because whatever we do in life, there is a risk associated with this, and the reward is something that we gain if we are able to manage it properly. So today we are going to spend some time around the regulatory requirement overview of the internal control framework. Yes, while we talk about the regulatory requirement, I think initially we will spend some time around understanding the risk and the controls landscape. What is risk? What is the controls? Why do we need to evaluate? What are the different dimensions? What are the different type of controls? Once we have that basic understanding, and then I will take the plane to the next scale where we understand ki, okay, why the regulators have come out with different requirements, and what are the Companies Act requires us to do in terms of evaluating the design and implementing the internal financial controls within our organization. And then to implement that effectively, what are the steps and the procedures should we be following it? And what are the relevant frameworks, guidances, be it for the COSO framework or the guidance from our Institute of Chartered Accountants? How do we leverage that? And what is the right way of evaluating and ensuring that the internal control frameworks are appropriately implemented? So, so as I said, before we get into, let's understand what is risk. Now, in general, we can always say anything that go wrong could be a risk. But then don't you think that we could use the word wrong, misappropriations, and many other similar words rather than the terminology, defining a new terminology as a risk? So when we say risk, it is something which is something which is not intended, which does not go as per our plan. But more importantly, and the litmus test is, it is something, if it happens, it may impact an organization or an individual adversely to achieve their objective. Now, this is something which needs to be underlined and understood. Any adverse event, if it has a potential to cause any harm, and because of which we may not be able to achieve our objective, in that case that underlying event may be classified as a risk. Now that is very important. So when we look at the entire framework, or how do we evaluate about the risk, that is always something that we have to keep in mind, that because of this, is it something that is going to impact us, or is it something okay which could have been done better, but probably it is not going to impact us in an adverse manner? Now, that is one thing. Another thing is, why is it really important that an individual and an organization needs to understand and evaluate the risk properly? Why do we looking at a structured discussion around it? Because whenever we say, you take an example of any promoter or any businessman, even if he does not understand the risk management internal control framework, you have a discussion with them, and if they are running a business for quite certain time, and they would always come out to what are the different challenges, what are the risk that they are facing in the organization. Now, that's the general question which as a risk professional you will always encounter, that why are we looking any structured approach around it? And then the answers lies into it. If we follow an structured approach, then it is highly likely that we may not miss out any important risk evaluation, because otherwise it's a hindsight. And there's so many organizations which are very successful, and there's so many organizations which are not so successful. And the reason, one of the important reason is that probably they have not evaluated the risk properly. Now, having said that, why is it important to evaluate the risk? Uh, and here's a saying which we always use, that a ship is safe in a harbor, but that's not what the ships are intended for. Because whatever we do, whatever business activity we do, there would always be certain risk. But does that mean that we do not take the risk, or we do not even do the business, or we do not take any actions? No, that's not the intention. The intention is that we follow a structured approach, evaluate the different possibilities what can go wrong, and we are absolutely ready in advance that if that uncertain event is happening or about to happen, either we mitigate it or we are able to minimize the impact of the risk. Now, that's what we call as a control, and that we are going to see in the subsequent slides as well. Now, let's take an example from a daily life. Now, risk is everywhere, as I said. You are crossing the road, there's a risk that you will get hit by the car. You have to reach your office by 9 a.m. There's always a possibility that there could be traffic jams or the accidents. Cutting the vegetables, you could cut your finger, likewise, and so on. Now, what does that mean? Should I not cross the road? Should I not even start from my home to go to the office? There are certain risks which I can control. So, take an example, I can drive my car slowly, but traffic jam is something which may not be in my hand. But if I have to go for a mitigation, I may plan based on my experience and try to leave home little early. Try to identify which are the most convenient time slots, and what is the appropriate time or the generally time which I take to reach to the office. Now, all these are very classic examples of in our day to day, whatever we do, it has some or the other risk attached to it, which can prevent us from achieving our objective. But yes, if we evaluate them properly and have a mitigation plan to it, we will be able to overcome the impact or the adverse effect of that risk from happening. Now, before we get into the control environments, I think it's important that we understand what are the different categories of the risk which an organization is posed to. Now, here we broadly classify them into the environmental risk, the process risk, and the information for decision making. I'm not talking about the risk category which the COSO framework or the ERM frameworks are defining, but this is very important to understand from a general standpoint, because something which could be in the control and something which you can either watch, keep in radar, or maybe able to transfer it to some other person, but I may not be in a position to control it appropriately. So, take an example, the environmental risk. Some natural calamities there. Something happens cross border, and I'm into an organization which is into the import export business, or highly exposed to the foreign exposure and all. Now, those are the kind of a risk which directly an organization may not be into the able to control. However, through a proper analysis and keeping a watch of it, I may be able to take a timely action and be able to minimize the consequential impact of such risk. And the other category of the risk could be the process risk, which typically would be the operations related or the process which an organization is performing related to that, and largely controllable within the organization through having a modified process, a maker checker, or through the system enablement, or many other various examples that we see. And typically, the operational, the empowerment, IT, of financial integrity, something financially going wrong or financial reporting wise going wrong. I think those are the typically the risks that we talk about when we cover the process risk. And then third is the board level, the strategic risk, which by the virtue of being into a particular business, you take a decision ki, okay, if I'm into an aviation business, there could be a certain strategic risk. It's a high investment, right? It is highly regulated, likewise. So as a strategy, whenever I will launch a new product, enter into a new geography, enter into a new business, there are certain tactical strategic level risks which the organization needs to evaluate and monitor, may not be at a process level, but definitely at a governance level. Let's take some examples. Let's take some examples because today the more time that we are going to spend will be more around the process level risk. And that's where, from the practical implementation standpoint, any internal control framework will be more relevant. Let's see step by step how do we go about it. I've taken a very classic example of a procurement process because that's more lively and easily understood by all kind of an audience. The typical objective of any procurement organization, what is that? That I am having a good quality material at an optimal cost, and I'm going to attach few more attributes at the right time as well. Because even if I procure a good quality at a right cost, but the vendor is not supplying me on a timely basis, definitely it's going to adversely impact my production line and I may not be able to achieve my objectives. So I have a good material. The definition of the good material will be the right set and the parameters of the material which I am wanting for my production, right? Because otherwise there could be various segments. The kind of material that I want to buy, that is available at the most optimal cost and at the right time. And to achieve that, the organization undergoes different steps that you invite the vendors, you get into the RFQ process, you appoint them, you place the order, you receive the material, and then you make the payment to the vendor. This typical high level, the purchase process, the procure to pay. And if I look at the appointment of the vendor, there could be the different risk that could be associated. One is that I do not even invite a qualified vendor for the quotation. Now, there is a vendor who supplies me a very good material, but I don't know them. I'm just keeping on inviting the quotations from my typical set of vendor, and consequently, I may not get the best possible price, right? Leakage of the information, so the vendor is able to play with that and not give me the right set of competitive price. I do not get into a right set of a contract which can financially or legally adversely impact me. There are delay in the receipt of the material. I do not receive the right quantity or the right quality. Or in the payment, I'm not able to make the right payment, either the double payment, less payment, more payment. In the entire process related to the material, related to the quality, related to the finance, there are n number of things that can go wrong. But we need to evaluate them and mitigate them. But how do we go about it? We need a very scientific and a step-by-step method and approach for that. Uh, so there is a bridge between the risk and control that we call as a root cause. Let's understand what is the root cause. And at times the risk and the root cause are misunderstood and interchangeably used. So I'll give you a litmus test for that. And that is very important to understand. So risk is something that we have understood. Any adverse activity, or sorry, any event that could adversely impact me to achieve my objective. So adverse impact is very essential. What is the root cause? So by definition, we say root cause are the reasons which could cause the risk to occur, right? So the reason because of which that adverse impact can happen, that will be the root cause, that do not expose the company to the liability or possibility of their loss on their own. So on their own, they will not be in a possibility of an adverse impact or a loss or liability. but that could be the reason because of which the organization may have to face a risk. Now, this may sounds to be a little technical, but I think with the example, we'll try to understand. I taken a very practical example that there's an organization who is into the manufacturing business, and being an accident at the site, that could be a risk because it could impact the organization both financially as well as from the regulatory standpoints. But there could be various reasons because of which an accident can happen. So the organization do not have the proper health and safety policies at the sites. You do not practice good safety or the ESC processes. The equipments which are being used are not regularly maintained, right? So there could be a damage. The safety and the alarms are not working properly, or the quality of the equipments are not proper. Because any of this, it may, if this occur, it would have a high probability that it can result into an accident at the site. So these events we will classify as the root cause, but what eventually the risk will be the negative impact or the adverse impact which could be there to the organization. Now then, what is the control? And hence, why I say that the root cause is the bridge between the risk and control is because to be able to manage the risk properly, we try to put the controls around the root causes. So, if we are able to prevent the root cause to happen, then I think we are in a good position to have the good control environment, either mitigate it or manage it properly. So, by definition, how do we understand it? The control is any action taken by the management. So, first of all, it's an activity, it's a tangible activity and an action. The management, the board, or any other party to enhance the risk management, and important is increase the likelihood that established objective and the goals will be achieved. So the risk was something that was decreasing the likelihood for the objective to achieve, and the control is something that will increase the likelihood for my objective to achieve, or reduce or mitigate the adverse impact of the risk. So even if I am not able to increase that likelihood significantly, but be able to reduce the impact significantly, so eventually at a residual level, the net impact or the adverse impact on the organization is in the very well appetite of the organization. So taking this similar example ahead, if I have to prevent or manage the accidents at the project site, what I will do, I will ensure high safety of the machinery and equipments, regular maintenance activity going on, regular upkeep and the checks of the alarms, safety nets or the safety measures, maybe some regular safety audits and keep on implementing their suggestions. So all those kind of an activities. What we are trying to do, we are trying to identify all the reasons which could result into the accident, and we are trying to put the mechanism to avoid such events to happen. And hence, to the risk, we identify the root cause. To manage the root cause, we divide the control, and eventually through these controls, I'm able to better manage, handle, minimize the risk for the organization. And hence, my root cause, the risk and the impacts are interrelated. That's how we see. And another important aspect here is that there could be the multiple root cause for a risk, or one root cause could eventually result into multiple risks, right? And hence, it is not necessarily a one-to-one correlation, but having a very organic linkage when we look make this into a matrix form that we are also going to see in some of the subsequent slides. But when we do a very objective study around it, we try to identify what all can go wrong in a process, identify the different root causes, and then eventually have a controls. Then we focus on implementing those controls effectively so that all my root cause and the risk are appropriately addressed. So that's the linkage between the risk, root cause, and the controls as we discussed. Now let's try implementing this into the example that we saw. We again take the procurement process, and then we now take each and activities separately in isolation. Let's focus on the tendering activity. We have to invite the quotations, the RFQs from the different vendors to have the best possible price. The risk could be, I'm taking two risks for example here. either I do not receive the quote from the qualified vendor, or there could be a leakage of the information on the financial bid, which could adversely impact me that I do not have the best possible price. Now, what could be the reason? The reason is that I do not have the list of the empanel vendors, that I do not even have the most appropriate vendor in my list, to which I could invite the quotation, or my procurement team just uh, manage. So typically the organization would have the three bids or the four bids kind of a policy. They just invite three bids and just close the RFQ process there. I'm just trying to take the root cause list to the next level. Uh, so what would happen? Either through a deliberate attempt or through an error, I possibly do not invite the most optimum vendor, and hence I may not possibly have the best optimum quotations for my procurement, or else I do not have the adequate market information. How do we link it? So market information will impact me in two manners. One, that if I do not know who is the best person supplying this material at the best price, I may not eventually invite the quotation from that, number one. Secondly, in many scenarios, I do not have sufficient vendors for the competitive quotations or to have the competition between the vendors. Possibly it's a make to order item or on a design base, it's just a single vendor. Then I do not know the appropriate cost of that material. So I will always run on a risk that I may end up with a weaker negotiation and do not have a right set of a price negotiated with the vendor. So all these things, when identified properly, that in a particular business, what could be the root cause for this? And then I have the appropriate controls around it. One is that I keep on updating my empanel vendor list, either through keep on figuring out new and new vendors or through have the open tendering. And then I keep on updating my information. So take an example for one of the clients, we suggested to have the costing cell because that's into the automobile sector, and there the vendor is like through a very close healthy relationship. The items are design specific and the vendors are developed, and their machinery, the entire production setup is, completely interlinked with the production setup of the main organization. Now, it's not possible to keep on inviting the quotations every time or change the vendor. But what is more important is that I do know the right costing of the product so that on the table I can have the agreement on the fair set of a margin. So to increase that knowledge and awareness, the costing cell was introduced. So this combination of the finance as well as the engineering people who go to the market, evaluate what is the cost of the material, what is the cost of conversion, and then achieve at the right set of a costing. So the control will again vary on organization to organization, process to process. But the bottom line is that we start from the process, we identify what can go wrong, we try to figure out what are the different root causes for that reason, and then what could be the right side of our control to implement this. For the leakage of information and that I do not have the adequate security or the storage mechanism, there could be the possible collision between the employees. Then eventually the control could be that I, have the encrypted bits or the safe lock-in keys or have the appropriate segregation of duties so that if not one person is doing it, probably it will be very difficult to have the collision. And likewise, if I move to the placement of order, I could end up selecting the incompetent vendor or the contracts not appropriately defined. Again, the root causes again vary from organization to organization, but like inadequately defined vendor selection criteria. So I don't even know that on what criteria I should be selecting the vendor. I'll give you a very classic example. And typically, as an auditors, we go to the organizations, compare the quotation. Some of the organization may be just comparing the price of the material, but one vendor have included the freight, the other have not. One vendor have included the tax, the other have not. But the selection criteria are not clear. I'm not comparing apple to apple. I don't know what is more critical for the organization, the quality or the price or the timely availability of the material. And hence I may end up making up the wrong choices, or I do not award to the L1 vendor, or probably the L1 vendor is not supplying me the best quality material. So even if I select the L1, eventually it is adversely impacting my production and eventually the loss to the organization. So there could be the different sort of a combination again to be evaluated from organization to organization, but the mechanism will continue to be the same. When we go about the receiving, either the delays could be there, I do not have a counting mechanism and eventually receive less and pay more, and likewise. So what could be different reasons? Either I have not communicated the delivery schedule to the vendor properly. I may not have the vendor performance evaluation, so vendor is very casual that he is not bothered. So maybe I go and enhance my contractual arrangement that okay, if you supply X quantity delayed by X number of days, there would be the liquidated damages, passed on to you, and hence the vendor will be more enforced to adhere to the delivery schedule. So those kind of things could be there. On my receiving, whether I have the adequate quantity as well as the quality check procedures. If not, then I have the qualified people or the process set in the system that they be able to do that. Again, on the payment side, possibility of the duplicate invoice processing, incorrect invoice processing, material return but not debited to the vendor, all those kind of things could be there because of the various reasons, you know, enclosed into the underlying process, that either the people are not verifying the underlying documents, or the payments are not approved by the right people, or possibly the malified intention that the somebody in the organization have a collusion with the vendor and trying to make the incorrect payment for some favors. So all those things could go wrong, but we have to find the right root cause. So we are able to put up the right set of our controls in terms of right authorizations, right maker checker, or enhance my system, that the system itself. So very classic example is for duplicate invoice, that my system is able to give an alert that this invoice is duplicate. Traditionally, typically on the vendor name, date, and invoice number. Today, I will say with the advent of technology and the AI is kind of a system, the system is even able to go much much beyond and be able to through the machine learning be able to identify that even if somebody have a fuzzy number, so system will be able to do a fuzzy match and see ki, okay, it seems like that this particular material, this invoice, this vendor has paid in advance, and raise an alert for that. Somebody try to do the splitting of the payment to overrule the approval and the authorization requirement, but the GRCs of the system and the AIs are able to catch out ki, okay, there's a possible. Typically, we as an auditor always go and do that analysis, but today systems are also so advanced that these kind of controls we have implemented into the system itself, that the system will catch hold ki, okay, this particular payment somebody is trying to bypass through the splitting, and probably we need to stop this or having the right set of an approvals. So that's on there. That's on the risk side. But more important is, yes, we understand what is the risk, what can go wrong, and our experiences, we evaluate it. But then how do we mitigate it? So let's deep dive into the controls. Let's understand the controls in detail. And then we get into the more on the regulation side and the framework side. Okay. So what is the control? As a definition, we have seen the control is any action that will prevent or detect for a what can go wrong in terms of the risk. So risk is something what can go wrong. So the control is something important. Underlying word is prevent or detect, because control could be before the event, that it will prevent the any adverse event to happen, or it may not prevent but detect. Taking another example, that before making a payment to the vendor, the purchase order, the GRN, the invoice is verified by the finance person. He tallies this, takes an approval, verifies the vendor account, and then make the payment. So he does X number of checks, or maybe two people are involved, or maybe the finance head's approvals are involved. All these activities are happening before making the actual payment, which is will be the example of a preventive control, because all these things will ensure that the right payment happens to a right person. So it will be a preventive control. What could be an example of a detective control? A very classic and a typical example we always talk about is the bank reconciliation statement. So even if some payment happens, when we prepare the bank reconciliation and try to tally it with our bank book, any incorrect payment or any unaccounted receipts, we identify it and we take an appropriate action. Now, this control activity is happening post the event. Also, it may not prevent the risk. but it will help us to detect it. And hence, the nature of the control will be detective. Now, you will again ask me, sir, then what is the use? Why do we even want to know all this categorization? Theoretically, it sounds very good, but there must be some practical application. Yes, there is a practical application which we will touch upon also. But just to highlight at the right stage, always the endeavor for the organization is to go more preventive, because it is always better. Prevention is better than cure. So better the higher the preventive control is better for the organization. But again, the preventive controls comes at a cost. Now that cost is the efficiency and the speed with which operations may perform. If you put too many preventive barriers, it may be little inefficient for any transaction to perform. Then what do we do? Then we have to detect it. Okay, even if something does not happen. Today we talk about the robotics being performing the accounts payable function and the payments happening directly without even manual intervention. Why we are doing it? We are doing it because we want to handle large volumes in a minimum possible time with the being more efficient in the operation. But then we need a very good quality detective control. And in terms of detective control, the sooner we are able to detect it, the better it is. So the damage, the end damage, we are able to minimize it. So what is needed? When we are assessing the complete control environment and a framework, we need to have the right set of a balance between the preventive controls and the detective controls. So number one, the organization is able to achieve its objective without much damage to the wealth of the organization, to the objectives which are wanting to be achieved. And second, be able to operate in a very efficient manner, right? Because the controls and the audits are not to reduce the speed of the business, but then definitely to increase the speed of the business and give them a comfortable environment. Now, typical examples here is coming to my mind is when we always talk to the people, ki why do we have brakes in the car? Because the brakes are kind of a control. Somebody will say to stop the car, and what a risk professional will say, no, the brakes are there so that I can drive faster. Think of if I do not have the brakes in the car, I can't think of driving my car at 100 miles per hour, right? Because I know that if something goes wrong, I will be able to put my brakes. It's in my control. I'm able to drive faster. So that's how the controls need to be seen. And with that objective only, we need to evaluate and implement any control framework. Again, going to the second kind of a categorization, which typically will be based on operations. Operations means the nature of the control to operate. That's what the operations. So manually means somebody manually operating it, a manual judgment is involved, and a manual action is involved, right? I have the definitions also for this, but for a very simple understanding, let's evaluate that. Automated is something which I design and configure once, and the technology and the computer is able to operate that because that's more reliable. The why it is important is that once automated control is configured, in all the situations, it will operate consistently. But that's the limitation with the manual control. It may not operate consistently. So I may need regular training, awareness, and the people at times may take shortcut also. But not everywhere I can have an automated control. Then again, there will be a right set of a balance between the manual and the automated control. But the third set of also we also is an IT dependent control. That wherein I use the technology effectively to perform manual control in a better and efficient manner. So it's not complete manual, but I use the technology for underlying information or to operate the control. This we have discussed. So take an example here. Manual control not performed by the computer, automated control performed solely by the computer, but IT dependent control that we were discussing is manual controls that use computer produced information. Since the manual control relies on the computer produced information, so the effectiveness and the efficiency of that control will depend on computer as well. What if that report itself is not right? So another classic example is typically in the organization, you will see that there is an approval mechanism to approve any purchase order or to approve any payment within the ERP system that the organization will built in. Now, what if I do not have the right set of an access control? What if the computer do not operate properly there, right? What if my approval hierarchy do not tally with the actual delegation of authority approved by the board of directors? Typically, because it is again a mix of system as well as a person operating the control. What if even if in the SAP it goes to the right person, but the person do not have the right information or do not review the document properly before approving a payment? So even if it is automated, the effectiveness of the control lies with the person. If you do not review the payment and just click on approve, the control is not properly effective. And hence we call these controls as IT dependent. Unlike an automated control, where we configure the system to perform in a manner without any manual intervention. So take an example again, that I do not allow GRN to be more than the purchase order. I do not allow my payment to be more than the GRN or the material received. Once it's built into the system will behave in a particular manner. You will not be able to modify it. I have the masters within the system and I run the payroll, and my complete payroll is processed based on the employee master and the salary components based in the system. Now, I am not manually calculating it. I may be manually verifying it later, but once the system is configured, all the mathematics and the logic system will apply and come out with the computation. So that's the typical classification based on the timing and the operation of the control. But let's take some of the examples to be able to appropriately differentiate between the activity and the control activity. That's very important because the organization do so many activities, but not every activity is a control activity. We're talking about actuarial valuation. Now, company engages some XYZ firm to prepare the actuarial analysis. Now, this is an activity, but this is not a control activity because doing something, engaging something is only an activity. So, hiring a specialist is a procedure which may enhance competency but is not a control. So, the control will be management reviews and discusses the actuarial report, including key assumptions, with the specialist to assess the appropriateness of the assumptions and the conclusions raised. So just hiring the actuarial is not my control, it's an activity. But having the appropriate analysis being done, the report being reviewed, and then appropriate accounting being done with the maker checker, that will be the control. Another example could be the billed revenue file is summarized at the month end and the total is recorded into the revenue. Now, by the virtue of reading the sentence, you will always see, okay, somebody is doing certain activity based on certain file. How is it a control? How is it helping me mitigating my risk? So somebody recording something is typically a step, not a control. But if I have to talk about the control, the account manager verifies that the billed revenue was properly recorded to the revenue account by comparing the billed revenue file to the revenue recorded in the GL. So somebody has done it and the account manager verifies ki, okay, this was the total set of invoices, this is the total, and my the revenue figure tallies with that. Somebody verifying that, that will be a control because that is something that will ensure that my revenue is appropriately recognized, my revenue is appropriately recorded. So that's the difference between any typical activity and when we talk about the control activity. So that's the normal understanding of what typically we understand by the risk or the control. Now we get into some of the frameworks and some of the dimensions of the appropriate control environment. Before we get into the regulatory, what does the Companies Act says and how do we implement it? Let's also look at the different spectrum at which the controls are solved. A typical control environment, I think, is into three different levels. One is the governance, the tone at the top, the board, the kind of policies the organizations have made, the kind of the board review mechanism, all those things which are there at a board level, at a senior management level, are the governance. I have a right set of a code of a conduct. I have the regular trainings and the awareness. I have the risk management system in place, I have a compliance framework in place, are the typical examples of a good governance. My board reviews the financial statements before getting it published. Another example of a governance. They have the close review and the watch over the budgets, what's happening around the budgets, the through the MIS or other reporting mechanism. And the typical example of the governance, that how do they monitor the entire operations and set the right examples. If there is a whistleblower, how that is handled, so that there is a right set of examples, the fraud is not tolerated, or the management themselves are involved into some malpractices, then this is not a good example of a corporate governance. So governance itself becomes a very, very important pillar when we are talking about the entire control environment. Because if the governance and the tone at the top itself is not right, then the reliance and the appropriateness of the operation level control may not be that significant and that high. So that's one part of it. Second is the operations. Operations beat any activity. I have the HR operations, I have the production process, I have the purchase process, I do many other different activities. So what are the different set of controls the organizations built at the operation level that we cover into the operations? And then third is the financial reporting, because there are lot many stakeholders that rely on the financial reports and impacted by that. So and hence there's a financial reporting angle as well. Anything, any control which ensure that the financial reports generated by the organizations are more reliable, more transparent, all those kind of things will be there in the financial reporting bucket. And in the subsequent slides, we'll also see why this is important to understand this kind of an spectra. Because as we understand the companies, that there is a differentiation being done between the IFC, internal financial controls, and internal financial control over financial reporting. And hence, with the different objective of the regulator, there's a difference, and that this difference will be very, very helpful when we get to understand that kind of a framework requirement and how do we implement it. Another important aspect that will be important to understand is, though this model is redundant now, but I have kept it for a purpose so that we are able to see the difference which has come in. This is a typical three lines of a defense model, wherein at the first line of a defense, we say there is the management control or the internal control measures. It is here we include all those control activities which are performed by the people on the ground, which are typically the operational or the financial reporting. While the activity is being performed, I have the right sort of a control. Very classic example, again, as we just saw, I have the vendor comparative statement prepared and select the eligible vendor through an approval mechanism. Example of first line of a defense. I make the payment through appropriate approval by verifying the underlying documents. Example of first line of a defense. But then comes the second line of a defense, which is more entity level, supervisory level. A very classic example is that when I review the financial statements at the quarter end, or I compare the financial statements quarter on quarter, year on year, and CFO tries to identify that probably there is some error, that is the second line of a defense, which we're talking about more supervisory in nature. It is not at a transaction level, but it ensures that over and above my first line of a defense, the things are running fine while they report the things to the senior management and the board and the audit committees. And then comes the third line of a defense, which we call as an internal auditor. They are not directly involved into the operations, but then they go and check, then they provide their report, ki, okay, if something is wrong or how that needs to be corrected. Now, this we have discarded and the new three-line model has come in, wherein while we say that the internal audit lies at the third line of a defense, but it also plays an advisory role with the management and the governing body, so that we do not only do the fault finding, we also play a role of an advisor and help the organization through the suggestions building up the right set of a control framework, right? Why this difference and understanding is important? Because whenever we define any control framework, the control will always be at a first line of a defense or at a second line of a defense, because the control has to be implemented by the management. auditor, by the virtue of their position and the requirement posed by the law, they will come, evaluate, and provide their report and opinion around it. Though they can play an advisory role in terms of a recommendation, but typically anything a statutory auditor being doing or internal auditor being doing cannot be taken as a control, right? So the control will be something that the management has built in, implemented to ensure that the risks are managed well. Okay. Though this I have explained while we are discussing the previous slide, but we'll just also see. Then when we say, ki, okay, what is the control framework? How do we look at it? Then the role of the internal auditor. So the internal audit activity must assess and make appropriate recommendations. The important line is assess. My role is to assess as an internal auditor, find what is the gap, and make the appropriate recommendation for improving the governance process and the entire control environment as well, not only the governance, right? So that's the difference which has come in. I do not, so today as an internal auditor, my role does not limit just to provide a report, what is going wrong. We recommend it. What the auditor won't do, they will not perform the control. I'll give you another classic example. I'll not name the organization. Some of the organizations see that the internal audit head is there, and the internal audit head is part of the purchase evaluation committee, tendering committee, any other strategic thing. Somewhere some high value payments are being approved by the internal auditor as well. Right. Now, then again the thing. The internal auditor won't be performing the management activity that will not be considered as a control. But while they can participate in the activity to provide the recommendation, while I'm onboarding the vendor, they can provide their recommendation ki okay, these criteria should be considered in the evaluation, whether they have been taken care of or not. When we are entering into a very strategic contract, the internal auditor can evaluate the contract and provide their suggestions. But eventually, the final decision, the implementation will be done by the management. So that's the difference which has come in from the first line, second line, and that's how the internal auditor needs to needs to address it. That's one part of it. Second is where the internal audit at times typically we most of the time focus largely on the controlled transactions. And there was one study being performed on the assessing the quality and the efficacy of the various internal audit functions in the organizations, and it was understood that the most of the time it's more transactional and very less time it is more governance and the risk management oriented, that at a governance level what needs to be improved. So that's what the role is, not only at the operation and the financial reporting, the complete framework that we saw in this slide. As an internal auditor, by the virtue of their position, assessing the gap and recommendations to improve the complete control environment, both at the governance, operations, as well as at a financial reporting level, will be critical and vital for the internal auditor to assess and suggest. Okay. Having understood this, let's go on to the framework now. What is it that the Companies Act is wanting us to do? How do we evaluate? How do we help the organizations to implement and build it? Okay. So this is a summary slide. If we look at the Companies Act clearly defines the responsibility on three people. Number one, the board of directors. What do they say? They've laid down the adequate and effective IFC's internal financial controls and include it in the director's responsibility statement. Independent directors to satisfy themselves on the strength of the financial control. So one is prime responsibilities of the directors, that they lay down the adequate and effective. Now the key words to be understood here, and that is very, very important, is that adequate and effective IFCs they're talking about, which are little subjective. How do we ensure that is adequate? Having any set of a controls, if I go to an organization and the board of directors give me, okay, these are the 100 controls I built, how they ensure themselves that those 100 controls are adequate and sufficient? Number one, on the design side. Second is effective. What if the controls are designed but not operating? And that's the typically we always say, what's the point of going to a doctor and having a prescription if I do not take a medicine? It's a very good prescription. Having an adequate control framework is a very good prescription. But if the people are not following it on the ground, the risk will not be addressed. The problem will not be addressed. And hence, the lawmaker is also vigilant and mindful of it. So they have casted dual responsibility on the board of directors, that they have to ensure that the control environment is adequate as well as effective. How do we do this? We'll see. Second, the audit committee. So the responsibilities of the audit committee is to evaluate the IFC system. Again, so here the word is not used, lay down. So audit committee, the subcommittee of the board, but the role of the audit committee is to evaluate as a maker checker again. While the board of the directors is implementing it through the management, but the audit committee will have their own mechanism to evaluate it, because both internal auditor and the statutory auditors are working under the directions of the audit committee. Those statutory auditors comes under the regulations also, and there's the independent reporting. Uh, but the eventually being monitored by the audit committee. So audit committee evaluate the IFCs. They take the help of the internal auditor and the statutory auditors as their extended hands, eyes, and the ears to tell them what's right, what's wrong, where the improvement needs to be done. But what do? They evaluate. Again, if I talk about evaluates is only the one word used, what will the audit committee evaluate? It will evaluate what the board has implemented. So the responsibility of audit committee again goes on to, they will evaluate the adequacy. They will also evaluate the mechanism put in place for effectiveness. So both things goes hand in hand. Third, we comes to the auditor, and here the statutory auditor is specifically referred as, sorry, here the auditor is specifically referred as statutory auditor, the external auditors. So auditors needs to report on adequacy on the of IFC system and report on operating effectiveness. Here the specifically word used operating effectiveness. So again, the auditors also needs to give their report, comment on the adequacies, whether the system or the control framework which is defined is adequate or not. Again, a very subjective word. So you need a very scientific mechanism and a methodology to evaluate the adequacy. It cannot be just left to the individual's experience or somebody's personal point of view. Is there a mechanism? Is there a framework? Is there a guidance? Unfortunately, very limited in India, but by now this has evolved a lot. When the Companies Act came in, there are a lot of discussions and evaluations. How do we go about it? Okay. So to implement this, we have three responsibilities: board, audit committee, and the auditors. But what do we mean by IFC? What does the Companies Act say? I'll just read out this definition, and then we threadbare go into the details of each and every word of this definition, because the Companies Act, from the responsibility perspective, ends there. Then we go to the best practices or the guidance is issued by our institute, or the COSO framework, which is used by the management to implement. What do they say? But the Companies Act have only very limited explanation. They say, for the purpose of this clause, the above clause that we are referring, internal financial control means the policies and procedures adopted by the company. So they're talking about policies and procedures adopted by the company for ensuring the orderly and efficient conduct of its business. Don't you think this is too wide a spectrum? We're talking about all policies and the procedures. Again, they have not used the word defined, they have not used the word documented, they've used the word adopted by the company. It means in principle that is being practiced. The policies and procedures adopted by the company for ensuring for what? An orderly and efficient conduct of its business. So you need some yardstick and parameter to measure the orderly and efficient conduct. This itself is very subjective, right? But we'll see what is the best practices and what is the best of the frameworks are talking about this, and how do we go about it. Second, including. Now comes the inclusiveness. So they have covered everything, then some references coming in. including adherence to company policies, though I feel that the it's already implied in the word adopted, but it's been specifically clarified also. Adherence. I'm not interested only in the design. If the people do not adhere it, for the lawmaker, it is as good as the control does not exist. That is more important. The prescription needs to be taken and implemented by the organization. Second is the safeguarding of its assets. That's very specifically they say, ki, okay, to prevent the wealth, we're talking about all the assets which are there for the organization, all those are safeguarded. That's one of my objective. So somewhere the lawmaker is trying to give a direction that what do I mean by policies and the procedures, and within what references should we see these policies and procedures. They're talking about one of the litmus tests they have given the safeguarding of assets. Second, they have talked about prevention and detection of fraud and error. Now, these again, the four words, and every word has a very deep meaning. They're talking about prevention and detection. So I do not say ki whether it has to be completely preventive or completely detective. Remember in the previous slide, we have saw this distinction and I was mentioning that why it is important, we'll see when we go about the framework. So the lawmaker has left it to the best judgment of the people involved, the people who have casted upon with the responsibility that how much preventive, how much detective is relevant. But it comes from an experience that more the preventive is better from the control perspective, but there could be an appropriate balance. And they also say the fraud and error. Now, again, a very subjective term being used together, fraud and error. Now, fraud generally is seen at a very different gravity, that somebody through a malified intention try to deceive the organization with for a personal benefit. Again, no quantification. And the error. Typically, I have seen while discussing with the organizations, we quantify in terms of magnitude. If it's an error of 50 crore, 5 crore, we'll say, there could be some malified intention. But there's a fraud of 500 rupees, we'll say, there's an error. No, there is no quantification, is not the decision here. The lawmaker says fraud and error. Why so? Because the difference between the fraud and error is only because of the intention. If it has happened not because of any malified intention, it could be an error. It could be a big error, but it's still an error. But if it's done with a malified intention, that's a fraud. Either on the organization or by the organization, either on the management or by the management. For the purpose of Companies Act, all frauds are frauds. So they say the prevention and detection of fraud and error, because they say ki, I do not have any barometer to classify between fraud and error. And tomorrow, if somebody comes up with an explanation, the moment it is caught, and there is management will always say it's an error. Hey guys, we will not accept this, because in the definition, it's been clearly clarified that both frauds and errors be seen from the same lens. So that's how this needs to be interpreted. Another element is the accuracy and completeness of accounting records. So they have given me two more assertions here, that whatever the control environment I talk about, whatever policies and procedures we talk about, we are talking about that eventually it's been reflected in my accounting records, my financial statements, that's accurate as well as complete. So all transactions are reported collectively, all are presented properly as per the applicable standards and the regulatory requirements. That's what we mean here. As well as the timely preparation and reliable financial information. So they have used a very limited definition, but within this definition, by the use of so specific words, they have given us too many hints, too many directions, that when we talk about the internal financial controls in an organization, what is it that we are wanting to see and what kind of a control environment we are looking at. Still, for the sake of elaboration and explanation, I think this is the matrix I prepared. If you see, there are three parts to this slide. One is the IFC objective. This exactly is coming out from the definition which we just saw. Some of the objective we can classify under the operations objective. Some are the reporting objective, like efficiency and effectiveness of operations, prevention, detection of fraud and error. Eventually, these operations objective would have the impact on the transparent and reliable reporting as well. But for a level one classification, because eventually we want to reach, what do we need to do? To reach there, we'll have a simple classification. Okay, we have three main objectives for the organization. We have the right side of operations, we have the right side of reporting, and then all compliances are met. Because compliances not specifically mentioned in this section of IFC, though it's covered in the separate section, but we can't think of a control environment without having a good control on the compliance to applicable laws and regulation. So that goes together. Having set these objectives, what if we go into a little more elaborated manner? What is the IFC requirement? So IFC would want that we define policies and the procedures and ensure efficient operations, effective and efficient operations. Policies and procedures are defined, documented. Why so? Though the lawmaker has said adopted, but how do we demonstrate adoption? If as an statutory auditor, as an internal auditor, or any other lawmaker, or somebody goes and sees, how do we get convinced that the policy and the procedures are adopted? That can only be demonstrated if that is documented. And again, the COSO says, if the control is not documented, we may not be able to take that as a control. Because how do you demonstrate that? Hence, we elaborate it in a manner, define, document, and ensure that it's operating. Having effective delegation of authority and entity level controls, will deep dive into what do we mean by entity level controls, but specifically mentioning because whenever we talk about the control environment, through the appropriate segregation of duties, maker checkers, more than one people involved, this is a high probability that we are trying to reduce the gravity of the risk. And hence, this has been specifically classified and clarified that if we have effective delegations on all right side of our direction transactions, then we can say that we have the policies, the procedures for the efficient and effective operations. Detection and error, preventive controls on the fraud risk. So if not all, for the fraud risk, at least we have the preventive controls and the mechanism for timely detection. We discussed about it. Adequate control on the asset movement, loss, threat, risk identification, mitigation plan. Typically, we cover the asset verification, asset movement, and all sort of controls around here. All the controls which will lead to accurate and timely preparation of accounting records, which will ensure completeness of accounting. And again, same goes with the reliability of financial reporting. And then when it comes to the compliance, what is the mechanism adopted by the company to ensure that there is a legal compliance framework? The company by themselves, through first line of a defense and second line of a defense, will comply with all the applicable laws and regulations. Because specifically, we talk about India, it's a very complex legal environment we are talking about. Just to give you an example, I was working for a typical manufacturing company and they have automated their compliance framework. Even if we go to the individual line items, I saw there were 6,000 compliance requirements. Unique compliance requirements I'm talking about. If I multiply it with the locations, the different geographies and all, they were around 25,000 line items and constantly being reviewed and updated. Can we expect any human being to remember it and by only by the virtue of their experience ensure that all the compliance are met? So we need again a very structured approach around it, which we call as a legal compliance framework. Nothing but just a collation of all the applicable laws and regulation and a mechanism to ensure that all these compliances are met. So, summarizing, we have the IFC definition, some attributes picked up from there. What is the companies that wanting us to do? Elaborating in the form of what is it that we need to do? Eventually, to implement it properly, all this will get summarized into three: the entity level control, the process level controls, and the IT general controls. Now, that's what the COSO also suggests. I'll just give the glimpse of the COSO also in the subsequent slide. But we will pick each of these bucket properly and see what needs to be done when we're talking about the compliance framework implementation. But before that, another difference and differentiation is very important to understand, because if you would know that from the applicability standpoint, internal financial control is not applicable on all the organization, though from the governance perspective, it's a good practice. But from the regulatory perspective, there's a difference that for all listed organization and certain other class of organization, it's the internal financial controls, because this includes certain operation activities as well. For many other, it is only internal financial control over financial reporting. So why do we have financial reporting? Because they say any control failure, if it could leads to unreliable financial reporting, that is my litmus test for internal financial control of financial reporting. This is exactly the same which were earlier applicable for listing companies under clause 49, which is now LODR. So that bar of governance is raised by the Companies Act. So on all listed and many other, we have the IFC, we cover operation also, because it's felt that somewhere that operation failure would eventually impact my appropriate financial reporting and the safeguarding of the organization wealth, because a lot of external money through the shareholders or the PE or the bankers or the lenders, not the operational management, their money is involved. So how do we protect that? But for other, generally the closely held organization could only be the financial reporting. Okay. But through one example, let's understand what's the difference. It's at left hand side, you will see the typical purchase process activities. You would have procurement planning. Then you would have the vendor master maintenance. Somebody will raise the requisition or the requirement of the purchases. Somebody will go for the tendering, invite quotations, and identify the best quote. You will have the vendor selection and negotiation. Will issue the purchase order. Will receive the material. Will record the invoice into the SAP or for any ERP or any accounting software. Will process the payment, and then we will evaluate the vendor performance. Now, all these are my operational activities which may impact my financial prudence or the adequacy of the financial judgment or the efficiency of the operations, I may say, but not necessarily the financial reporting. So, for example, if I have to buy a pen for the organization and that pen is generally available in the market for 100 rupees, the organization may be inefficient in their tendering process and may procure it for 120 rupees. But if my financial reporting, the GRN, the invoice processing, and the payment is happening at 120 rupees, I will say my financial reporting controls are correct. But I do not have operational efficiency. So my IFC control is a failure. So, that's the typical difference. How do we apply it to a process? I do the purchase planning. So at the purchase planning level, I do not do any accounting. So I keep it into my operational activity. At a vendor master maintenance, though I do not do any financial reporting activity, but my subsequent control of liability booking and the payment are dependent on my master, and hence I do cover my master controls into the financial reporting control framework as well. But yes, as a litmus test, by the virtue of just creating the master, I'm not doing any accounting. Likewise, at the purchase requisition, tendering, selection, negotiation, I may be inefficient there, but it does not impact my financial reporting. But my order processing, what if I do not put the right price? I negotiate 100 rupees, but I create the purchase order of 120 rupees. So even after my negotiation, I make up the wrong payment. It's a financial reporting. Receiving control, the moment I receive the material, how much material I receive, what is my liability that is accruing, how much payment I will have to make, all this will impact my financial reporting. Recording of vendor invoice, direct liability booking, the payment processing. If my financial report does not tally with my actual activity on the ground, it could impact my financial reporting. And hence, all these controls are part of my financial reporting controls. So there's a difference between IFC and IFCFR. I thought it's better to clarify just from the applicability standpoint. Okay, what is my complete components, or I will say the domain of my IFC framework. So it will start from the entity level controls. We will see what do we mean by entity level controls. But it generally addresses my governance pillar of the control environment that we saw earlier. I would have right side of a process level control. The activities which are happening, having the right side of a control at that level, we cover under the process level controls, including some of the period end controls, because for the financial reporting and to have the completeness assertion interest, all my activities which needs to be booked, recorded, and accrued in a particular financial reporting period, all those period and controls will be covered here. General IT controls, because all my IT controls which directly or indirectly impact my accounting systems or the activities which can impact my accounting, the IT controls around all that will be my general IT controls to be covered here. And then the anti-fraud controls. Yes, every control directly or indirectly will address, but since the Companies Act specifically mentions about having preventive detective controls or to prevent and detect fraud and error, we saw the definition. It's always prudent to separately identify and address the control assertions on the fraud risk as well. So that's the entire gambit. Let's see one by one, what do we mean by entity level controls? How do we assess it and how do we implement it? So entity level controls are typically the controls which operate at a governance level and impacts entity as a whole. A classic example is having the right set of policies and the procedures is my entity level control, because now this policy, once the board has approved it, this needs to be adopted by the organization as it is. There could be individual transactions, but all those transactions have to be implemented within the broad guidance and the decisions which have been taken by the board. Having a good risk assessment done again at the entity level, because at the entity level, we're trying to address what could go wrong for the organization. There could be certain entity level controls operating at a process level that we call as a process specific entity level controls. So a typical example could be review of all my account receivable, review of all my vendor payables, review of my financial statements. I'm not talking about an individual transaction, individual payment, individual receipt, but this is my entity level controls, process specific entity level controls, right? Because there is a governance element that typically it is second line of a defense, as we saw in my control environment framework, right? So that's there. Now, why it is important? Because it is very, very effective when we are going to do the operating effectiveness testing. So one, from the design perspective, we need to have the strong entity level as well as the process level. But the COSO and the best practices across the world say that if my process specific entity level controls are working effectively, are designed properly, my reliance on the process level controls increases and I may go with some reduced level of testing. For example, if I know that the CFO of an organization is closely monitoring my AR, my AP, the payroll, monthly MIs, and all that, then we say there's a high reliance that anything specific going at a vendor level, debtor level, or employee level, any payment, it will get attention of the senior management and it will be addressed. Not necessarily, but broadly to give the comfort to the external stakeholders and the management while we're talking about the complete framework, some extra reliance is there, right? Though typically for India, we do not adopt it because as a guidance note, we have been given for the operating effectiveness testing, depending on the frequency of the control, how many samples and all, we'll cover that as well. But from the understanding, it's important. What do we cover in the typical entity level controls? Business risk management. Whether, and understand a little bit elaboration, whether risk management policy and the procedures are in place, whether formal risk assessment has been carried out or not. Now, I've deliberately used the word here formal. Why so? Because otherwise, if you talk to anyone, you will always say, okay, in my business, we always evaluate it. But if it is not structured and documented, it may be difficult for any external person to assess and to give their opinion around it. So when we talk about having these controls, so better be documented. So if we have the risk management policy, a structured mechanism to identify what can go wrong at a strategic level, at a complete entity level, those practices we will include into the business risk management. The business ethics framework, what kind of a culture and the ethics the organization is demonstrating, and what systems and the procedures have been adopted by the organization, so that all the people either deliberately or forced to adopt an ethical culture, right? So whether the organization have whistleblower policies, the code of conduct, they have been defined, documented, including the steps taken by the management for effective implementation, as well as setting the right set of an example the moment somebody breach this. Because if that is not being done, the effectiveness of those kind of an ethics framework will not come. So all that collectively we will cover under the entity level controls of the ethics framework. Internal audit and the financial integrity. Now, having an internal audit function and a setup independently reporting to the audit committee is the entity level control. But as an internal auditor, when we go, I may check the process level things. So there will always be a difference. But through a board that I give the complete independence to the internal auditor, they go and directly report to the audit committee. The roles and responsibility of the senior management is defined when we talk about the financial integrity. That there is a segregation of duty, there's a review mechanism, right? There's a complete independence in terms of the person who is processing a financial transaction and somebody reviewing a financial transaction. There's a financial integrity element gets increased. So having this kind of a setup, we're talking about the entity level control. Again, legal compliance framework. Having a good compliance framework wherein the organization document and identifies what is the different acts and the provisions applicable in the organization, have an appropriate mechanism to keep updating it, and a mechanism to implement the people ensures that compliance, including the board's mechanism to monitor the compliance, will be collectively called as a legal compliance framework. Again, when we talk about ensuring a particular compliance, for example, depositing the TDS as per the due date, submitting certain returns as per the due dates, that is a process specific compliance control. But having a compliance framework to ensure that the organization is largely compliant to the requirement and unintendedly any important compliance is not missed out, you call it a compliance framework. Fraud risk management. Specifically, the IFC definition is also talking about it. But again, when we talk about a process level, somebody doing a fraud, excess payment being done, duplicate payment being done, that's a process level control. But the organization have defined a fraud risk management policies, including the mechanism how will a fraud be identified or addressed the moment it is noted, how whether it will be a zero tolerance, what kind of an action organization may take, and even at that level identifying what are the more fraud prone aspects or less fraud prone, and having the right set of a control environment on those activities. Having this entire setup because of fraud risk management, that at an entity level, what are the different initiatives taken by the organization to identify, deter, prevent, and investigate any fraud incidents, including how do we respond to any fraud event. Ensuring and business and operations continuity. Typically, we cover the disaster recovery plan and the business continuity or the crisis management. When we talk about a documentation, we talk about a policy. But in substance, we'll talk about all these practices taken by the management that will ensure that the business continue. Any senior management person, though we covered this in a succession planning also, Any critical person who know a production formula, who have a very key relationship with one party where my 80 or 90% of the business is dependent. What if that person leave? My entire business continuity could be questioned. All my data is at a particular location. I do not have a disaster recovery site or a mirror site or a backup mechanism. If something happens at that place, a business continuity could, any event which could impact my business continuity adversely, we cover it here. Succession plan we discuss, including the management operational review. We discussed that the entity level controls process specific. For my purchase, my vendors being monitored, their performance being monitored, the AR being monitored, for the debtors, reviewing the AR. So all those operational reviews, including operational as well as financial reviews, covers under management operational review. So the kind of practices adopted by the management to ensure all these aspects are appropriately addressed, controlled, documented, and demonstrated will demonstrate the strength of the entity level control. We then come to the process level control. Here we cover the specifically the transaction specific the controls defined. Again, going back to the IFC requirement, they talk about the design effectiveness as well as the operating effectiveness. How do we do it? For every process, we start with the significant policies and the procedures defined because the Companies Act has specifically mentioned about it. So, for example, when we say procure to pay, the procurement function, we start with what is the purchase policy, what is the SOP adopted by the organization. So either it is documented or not documented. If not documented, we may need to assess it, but better documented because then the demonstration of the control and the practices will be much easier and much more reliable. So then it's more about testing whether that's been people are following that or not. So that's the bucket being addressed. And then second, we commit. I'll deep dive this also into subsequent slides, but the risk and control metrics. The risk and control metrics is not the control framework, but this is again a mechanism to demonstrate the control framework adopted by the organization. Today, in the Companies Act, the Companies Act have casted the responsibility on the auditors also, on the audit committee also. Audit committee need to evaluate, auditor need to give the report. But if the management just say that I have the right set of a control in my purchase and the payment process, why do somebody rely? This has to be documented for an effective demonstration. And the mechanism to demonstrate that we call it as a risk and control metrics. What do we do in the risk and control metrics? We identify all the process activities. We mention what could go wrong. Again, depending on the applicability, if it is IFC, both operationally, financially, and the financial reporting. If it is only ICFR, that what could go wrong on the financial reporting side, whether it is a fraud risk or not, what is the level of a control, what is the controls implemented by the organization to prevent or timely detect, and then further attributes. When we document it in a structured manner, the demonstration of the design becomes easier and somebody can evaluate and see, okay, if an important control or a risk is not addressed there. So that's one part of it. So again, for the simplicity of understanding, this becomes my doctor's prescription. Risk is my problem or a disease. My risk and control metrics demonstrate, okay, what is the prescription I need to take to address that disease. But what if that control is not operating on the ground? So again, when we say the operating effectiveness, I will first see the policy of the control testing and the operating effectiveness. What is the procedure adopted? Because the Companies Act have just mentioned about the board of directors to ensure effectiveness. How is left to the management? Why this policy is needed? Again, for one, good governance, entity level controls, the operating effectiveness be assessed under the management direction. Second, eventually the responsibilities of the board of directors. So the board of directors needs to tell how they ensure the operating effectiveness. How do they demonstrate it? In the form of a policy. What this policy could be there? This policy could address the frequency of testing. Somebody will say, I will go and test once in a year. Management will say, some other management will say, no, I want the control testing every quarter, or may vary the frequency depending on the output. Or somebody will say that my key controls be tested every year or every quarter. Some other management may say, no, my key control needs to be tested. All my control needs to be tested. So there could be different parameters, combinations, and the requirements. How the management wants to ensure the operating effectiveness, you define the policy around it. So there is no subjectivity. Second is you go take certain sample, test it whether the control as designed is operating effectively or not. The control as designed. So if the control is that the payment is released after the approval from the finance head, we go and check certain payments on sample basis and see whether the finance head has approved that or not. That is one way to see it. But then how do you demonstrate? The ideal best practice is that document it in the form of a test script. That all the samples taken, what is my test attribute or the control requirement, whether that is pass or fail, right? So that's how we do the assessment around the design of the process level control, and then the assessment of the operating effectiveness, including the demonstration. Because when something comes as a compliance requirement, once we have this in essence, as well as demonstrate in an effective manner. So we talked about three things: ELC, PLC, and the ITDS. So we discussed about entity level control. We discussed about process level control. Now we will come to IT general controls. IT general controls again talk about the controls around the systems. These are divided into two things. One is general. General is something, how do we protect the application which is used for financial activity and financial reporting from any undesired event. So my typical controls will be my server where the application is hosted, whether somebody can go and do damage to that, my physical access control, whether I have the backup mechanism, again addressing if my system goes down, I do not have the data, regular upkeep and maintenance of my applications, servers, all these things will come into the general controls around the financial reporting systems. Second will come the application level ITGC. So take an example. I am restricting the access to modify the salary components of an employee with the HR head is my application control, because nobody else can go and change it. So my reliance on the payroll processing increases. Again, through an appropriate access, I am controlling it. The logical controls that we saw, that system does not allow me processing duplicate invoice, system does not allow me, all those are controls which are built within the application. And hence, those are my application specific controls. So my access management, my segregation of duty management, my antivirus, my backup mechanism, all this we will collectively we put in the application level controls. Now let's see some of the examples, like when we talked about having the right set of a password policy. Because if even if I manage the access, somebody is able to crack the password of the HR head and go and change the salary. So one is my application level controls, and then I have the strong password mechanism that becomes my IT general controls. If my data is transferred from one interface to another interface, there are two applications, or somebody is uploading an Excel file, the controls implemented to ensure data integrity, again, IT general controls. Restricting any unauthorized access depending on the sensitivity. My reports are generated correct if some activity are being performed on the kind of reports which are generated. If I'm changing the system, whether I'm doing a proper testing around it, the UAT around it, because it could impact my performance of the process. All this control will cover into the application specific. But then again, on the general side, we saw certain examples. Testing of the software, any patch management before that's been implemented, because there could be some any malicious activity which could impact my software. data backup and restoration, any activity to prevent unintended intrusion, either to prevent it or to timely detect it within my systems, is a part of IT general controls. Communications, any data leakage, confidential in impact. Today, the organizations implement the DLP, data leakage protection mechanism, through some keywords like somebody is not able to send an email to an outside party, for example. That's again a mechanism. Or if it's allowed, that will go through a monitored mechanism that through some keywords it will red flag. So all those kind of controls are very specific examples of IT general controls. Now that's been there. We saw entity level controls, process level controls, then the IT general controls. For a senior management, once we define it, assess it, document it in a form of a risk and control matrix, and then do a testing around it, whether this is operating effectively or not. But eventually, the Companies Act have casted responsibility on the board and the audit committee. The board may not be able to review each and every line item in every board meeting. So this kind of a dashboard and a snapshot may be presented. Ultimately, from the regulation perspective, it's the board responsibility. Eventually, they need to decide. But again, from a common practice perspective, so kind of a dashboard wherein you have all the business cycle, the count of risk, the count of fraud risk, the controls mitigating the fraud risk in terms of preventive control, detective control, the manual and automated. Again, on the bifurcation on the control side, how many are preventive, detective, manual, automated, and the key and non-key. Now, this kind of a dashboard could be seen, and that's where the board draws a comfort. Higher the preventive, that's the better the comfort. More the automated control, the better it is. So that's how they can review and can give directions. Another important aspect is this is very important from the while the auditor goes and assess the adequacy and effectiveness. There's a concept of materiality also, and there's a concept of completeness also that we need to keep in mind. That how do we ensure that all my important activities, all important risk and controls are addressed in the framework. So the ideal mechanism is you start from the trial balance, the financial statements. We go and reverse map that all my heads, which are the process and the activities in the organizations, are impacting this. And if we assess and review the risk and controls on all those activities, we can draw a reasonable comfort that my framework is complete, the design is adequate. That's how we try to address it. So that is one part of it. Second is on the materiality aspect. Now, for certain example, take an example of a travel expenditure. I generally takes a very classic example. For some organization, they are involved into a very minimal travel expenditure, only on a need basis. Some employees are taking a cab. It may not warrant a specific control in my risk and control metrics. I may have an inclusive control in my finance and accounts procedures. How do we review and pay for expenses whenever any expenses comes in? I may have the review by the functional head. Finance team checks it and makes the payment after the approval of the finance head. It is an inclusive control of all kind of expenses. But what if for another organization, my travel expenditure, it's a service or a BPO kind of an organization, it's substantial expenditure. Then the concept of materiality will come into the picture. My framework may require me to document specific risk and controls around that. So I will call out sorry, a specific activity, travel expenditure, how my travel expenditures are initially incurred, approved, monitored for the adequacy of fictitious bill or the fictitious travels being billed, then somebody reviewing it and making it, specifically calling out the risk and controls on these activities. But then again, the classification and the composition will go from review of the financial statements, a judgment around the materiality and the coverage of activities. So hence this scoping, we generally call it scoping activity for the IFC, important. This we have seen in a manner in terms of how do we evaluate the design. We start from the activities, we do the scoping. After that scoping, we identify all the activities which are impacting those account statements. On all these activities, we identify what could go wrong, that will become my risk. And to mitigate that through the root cause, what are the controls in place, that becomes my control framework. So that's the above portion highlighted into the red circle also. If we have a comfort around that all the important controls are appropriately identified, addressed, documented, so that's the stage we say, ki, okay, my design adequacy is there. And through this, we have a very scientific mechanism to draw out of a comfort that all my required controls are documented, identified, and implemented. So that's one part of it. While we do that, while we do that, we may come out certain gaps. What do we mean? We may not have the sufficient control to address that risk. For example, that somebody in the finance looks at the invoice and just process it, may not be checking it with the purchase order whether the rate charged by the vendor is correct or not. I'm just hypothetically taking an example. So it's a gap. What we need to do? We need to remediate it by building the appropriate control. Then my recommendatory responsibility comes into the picture. I will recommend, or in discussion with the management, or management may design any other comments, compensating controls. So you will design ki, okay, that along with the payment, somebody is responsible to check with the purchase order, or I built a system around it that my invoice will be booked only at the rate appearing from the purchase order. So that's a remediation. So we do the remediation. So we implement that recommendation and then again test ki whether the people have started adopting it. Once we plug all these gaps, my design is adequate and complete. So that's one part of it. Then we evaluate the control effectiveness, as we just mentioned. Okay, we go do the testing around it and see with certain number of our controls. Some, if some of the control count fails, somebody pass, will accordingly say ki my entire control is pass or fail, and then we report to it. So design effectiveness we have seen, but another aspect I will address it is here is the controlled financial assertions. Now, completeness of the risk we have seen that, okay, we have the activities, the account ledger map, we have the activities and all the risk. We identify the controls we just saw and discussed. But have we ever thought of how do we ensure whether my controls are complete or not? So in this similar example, I could have the control that my finance person is processing the invoice properly. So it is accurate, that the prices are right, quantities are right. But my financial report will not be true and fair if that person do not process all the invoices on a timely manner. My vendor has given me the invoice, but before 31st March, I have not processed it. Whatever invoices are processed, those are processed accurately. So it addresses my existence and occurrence. But I need a control that all my invoices are processed also. And hence, we need to draw out a comfort whether we have the sufficient controls in place or not. So what we do, so these are the assertions that I have the control for existence, I have the control for completeness, I have the controls for valuation and allocation wherever applicable, I have the controls for rights and obligation, and I have the controls for presentations and disclosures. For each and every item, we try and finding out, do we have the control in place addressing these assertions? If I have the control for every assertion, then I will say my risk is mitigated and my control framework is complete. So it's a reverse mapping that I will go and assess. One control may be addressing more than one assertion also. That's not a problem. But I should have a control for each and every financial assertion. Okay. Having said that, when we talk about the operating effectiveness, the kind of a checklist and the step-by-step procedures, uh, how do we go about the operating testing? We determine the testing objective. That's the control that is we are trying to test. We determine the failure conditions. Again, the failure conditions will be at two level. One, what is the attribute that we are wanting to test? So in this similar example, approval from the finance head before making a payment is one of the attribute. My invoice rate tallies with my purchase order is my another attribute. My invoice quantity tally with my GRN quantity is my third attribute. So likewise, in every control, we identify what are the attributes we test. Because if something is not tally, it means my transaction is not accurate. So we identify all those attributes. Second is my failure conditions. If I take 25 sample, whether I will consider my control pass or fail if one out of those control 25 samples is a failure. What if 3 is a failure? Or what if 10 is a failure? Do I consider my entire control as fail just on failure of one sample or how many percentage? So again, the management operating testing policy is to define it. Or else the typical best practice here is that you take a sample. If one or more than one sample are failing it, beyond a certain threshold, I will say my control is failed. If only one is failed, I will extend my sample. And if even a single transaction fails in my extended sample, I will consider my entire control as failed. So that's the typical testing practice followed globally. Then we define the population, that what is the uh, entire subject we are trying to address. In this similar example, the complete list of invoices processed in a particular accounting period could be my population. All my payrolls could be my another population. Likewise, determine the sample method. I do the random sampling or stratified sampling again, depending on the judgment or the principle that we want to follow. Sample size, again, depending on the frequency. Maybe if it's a continuous, I may take 25 sample. If it's a monthly activity, I may take 4 sample. If it's a quarterly activity, I may take 2 sample. Likewise, documentation. What is the documentation do I need to prepare? We discussed about the test script. What is the evidence do we need to retain to evidence the control is pass or a fail? Evidencing requirement. Evaluating the exceptions. While we do the testing, if there are any exception, we evaluate it in terms of why it is happening uh, before, or if we need to take the extended sample or not, or do we have a compensating control for that deviation? Because it's not only the failure we report, we also need to do the materiality assessment, the impact assessment of that control failure. Then finalizing the conclusion. Once that's being done, if if it's only a people issue, people may follow it in this subsequent samples or the subsequent period. But if it comes out that people are not able to follow it because of any design problem, we may go and reevaluate the control design framework itself and then do the retesting and the reporting. So that's the complete cycle. You identify, test, fail, reassess, retest, and then the report. If it's still a failure, it's a failure. This is just the snapshot of the sampling guidance by a guidance note issued by SCI for the different frequency. So that's on this. Thank you so much. That's the entire discussion around. We started from what is the risk, what is the control, how does a typical framework look like, what is the control environment, then deep diving into my regulatory requirement around it, and then to implement that regulatory requirement, what are the best frameworks or the guidances, the COSO requirements in terms of entity level control, process level, the ITDC level, how do we assess the design adequacy, and then how do we assess the operating effectiveness, adequacy. And with this, I think there's the entire requirement and understanding around internal control frameworks. So with this, I will stop my screen and happy to take if there are any questions. We have some time left. Will be good to address the queries also. Thank you so much.
We have one question, sir.
Please.
What would be the entity level control required for related party transaction?
That that generally frequently asked because I know that's the challenge area. As an auditor, we always face it. How do we draw a comfort around it? But I am happy to have the quality of your question because you mentioned about entity level control. Believe me, best of the control on the related party could only be the entity level. Now, the entity level controls for the related party transaction will be the board mechanism one, to disclose all the related parties, because the related party would always be by the virtue of the organization level connectivity or the directors level connectivity. So it becomes
Video please
the
trigger.
governance requirement that the boards are disclosing
Video
it.
please trigger.
And secondly, the mechanism adopted by the board to identify the transactions carried out with all the identified related parties. So there are two steps involved. One is identifying all the related parties, the mechanism, policy, the directions from the board for everybody to disclose it. So you have the list of the related parties. And second is the disclosure of the transactions, and that being discussed and monitored in the board meetings. This collectively will be my entity level controls on the related party.
Thank you so much, sir. We don't have any further question because the session was so nice and it was clearly explained each and every topic. So we don't have further question. So
I
we'll
hope
go.
so, but still I extend all my support. Any of the member, any participant have any queries. Since I've taken the numerous sessions on the control frameworks, the counting would be more than 70, 80 by now. So I generally try to address the typical queries in my session, but still, if there are any practical hurdles, any queries which you face, feel free to approach me, drop me an email, and I would be so happy to revert on that and try to address this based on my experience. So thank you so
So
much.
we got just now one question. What is the difference between IPE and IUC?
Uh, if person can elaborate, because I do not see the question in my chat. What do IPE? I know, information produced by entity, though I does not address that in the session, but I will explain that. What is the other thing they are asking?
IUC.
What is IUC? Sorry, you may have to
Uh,
the full form.
Miss Nikita, you can type in the chat box what is IUC you wanted to convey.
So by the time they mention about IUC, I will
Yes,
explain
sir.
IPE. IPE is the specific requirement, so it's elaborated in our guidance also. This is the information produced by entity. Now, what happens today when the management is doing any decision, making any reports, finalizing the financial statements, or even the auditor, when we go, we rely on the information produced by entity. So, take an example, there could be a vendor aging, and I have a control that all the vendors are paid timely manner. The finance head reviews my vendor aging to identify if there are long pending advances or long pending vendor balances, or likewise on the debtor aging also. But the effectiveness of this control will depend on the accuracy and correctness of the information produced by entity. What if my system itself is not giving me right debtor aging report? What if my system itself is not giving my the vendor aging report? So the controls adopted by the organization to ensure accurate and complete information produced by entity are the controls we call as the controls around IPE. So for that, we first of all identify what are the information produced by entity, because many of my control would be relying on the IPE and then assessing whether I have the right set of a control. A typical example again could be that I have the system configuration to pickets and the management have the adequate UAT done to check and ensure that my data aging report generated by system is correct. So that UAT testing will become my control around information produced by entity in this case. Trust that address the IPE requirement. Sorry, I'm not clear on the IUC. You may
Information used in control.
I think that's the extended version of IP only in the similar example. So information produced and used. There could be so many information which the organization is producing, but not part of the control. So this is a little technical to go, but for the control framework, IPE used in the control is only relevant. I'll give you another classic example. Where the material is coming in, my security guard typically you would have seen prepare a register, and they keep noting who is coming in, which vehicle is coming in, and all that. Now, if I use that register as a gate entry control, tomorrow to reconcile whether I have done the GRN and a liability booking of all the material receipt, then this information produced by entity becomes my IUC, because this is the information used in the control. But if I have a compensating control, I do a gate entry, take an example separately into the system, or I have another compensating controls around that I directly look at the GRNs, then this is the information produced by the entity, but not used in the control. So not of much relevance to me. So that's the little differentiation. But if I look at the control framework, IPE used in the control will become my IUC, and that's more important for us. But typically in the Indian frameworks, I'll give you the practical insight also. We do assess IPE, generally do not classify IUC separately. We presume that here the IPE mentioned are all IUC. Trust that address it.
Yes, sir. So we'll proceed with the vote of thanks. We don't have any further questions.
Thank you so much.
So on behalf of Board of Internal Audit and Management Accounting, ICAI, I would like to thank CA Mohit Gupta for giving us the wonderful knowledge on the topic, wonderful insight with beautiful example and illustration. So the participants have gained a lot throughout the session. Thank you so much for the session.
Thank you so much, Kinjal. And thank you so much to all the participants and attendees to spare time on a weekday. I know for Delhi people, it may be an off due to election, and trust that we have, casted our vote and fulfilled our responsibility as a true citizen. So enjoy your day. Have a good day and thank you. Take care.
Thank you, sir.